Well, good morning, everybody, and thank you very much for joining us on this webinar this morning. We're delighted to be welcoming you for a scheduled 1-hour session to talk about opening up trade routes to China. My name is Oliver Jones. I'm the Chief Executive of Chayora. And as Chayora, we're delighted to be hosting this event jointly with our partners from Telstra and also from the European Union Chamber of Commerce in China. It's very important at the moment that we all recognize the great opportunity that China presents to us. We've seen radical change in the course of the last 12 months in terms of how business is done internationally due to COVID. But the relations with China have had a rather more rocky period from the digging in of the US-China trade war over the last couple of years. We've seen some good progress on that with the phase 1 of the trade agreement being signed last year, but we were really all waiting for the US presidential election to be concluded before we could determine what was taking place next. But during that period, the European Union has been seeking out opportunity and developing its lines of trade with China. China, one of the most important and potentially a future leading global economy in GDP terms. It'll be interesting to hear the insights from our colleagues in the European Union as we get into the course of this debate. I'm delighted to welcome as my co-hosts in this particular event, we have Jacob Gunter. Jacob is the Senior Policy and Communications Manager for the European Union Chamber of Commerce in China. We have Matt Williams, who is the head of Europe, Middle East and Africa for Telstra, and it's a pleasure to have you with us. And we're also joined by CT Yan. CT is the Chief Executive of PBS, which is Telstra's joint venture in China. So I think we're wonderfully placed in order to have the benefit of exploring the knowledge that they and we have had in moving into China. What we'll be doing is, after this brief introduction, I'll be passing over to Jacob, who will give us an insight and some slides that will cover the perspective that the European Union has on trade routes in China and some of the opportunities at the moment. We'll then cut to some reflections on that from myself, from Matt, and from CT in terms of how that relates to our business and empirical experience on the ground. And then part of the reason that we're hosting this event at the moment is that we'd like to show you the new world-class data center campus that Chayora has launched just outside Beijing, and which we, with Telstra as our partners, are now operating to deliver anything from co-location services to hyperscale services. We've all become acutely aware of how important digital infrastructure is to the world in the course of the last 12 months, and building very large, very advanced data center complexes is a very important part of how international companies will do trade in China going forward. Our facility is a very large one. We'll tell you more about that later on, but in broad scale terms, it's a 32-hectare site, about 100 kilometers outside Beijing, with enormous power, over 300 MVA of gross power. And we're developing a range of data center facilities that will ultimately accommodate around 25,000 racks. That's about 500,000 servers to allow both international businesses and leading domestic businesses to do first-class business and do it in a way that is reliable, sustainable, and robust. But we'll show you that a little bit later with a fly-through video, and that we'll then conclude with a wider debate about some of the questions that many people are asking about trade routes and doing business in China today. And if you do have questions, as any of our attendees, please use the chat facility, and we'll try to pick up some of those questions as I bring this to a conclusion at about 5 minutes to the hour in a little over 45 minutes time. So with that introduction behind us, it's my great pleasure to introduce Jacob Gunter. As I mentioned, Jacob's the Senior Policy and Communications Manager for the European Union Chamber of Commerce in China. And Jacob, I'd like to pass over to you to give us your thoughts and share some of those slides, and then we'll have a little conversation later on. So Jacob, over to you.
Yeah, thanks for that. Thanks for that introduction. So yeah, as mentioned, I'm Jacob Gunter, the Senior Policy and Communications Manager of the European Chamber, stationed up in Beijing. So not too far from where this data center is going to be. And Oliver, you mentioned sort of the trade war and the decoupling that's going on, and how that might move going forward. And we're actually in the midst of creating a report on the effects of decoupling on European companies. So when it comes to the Q&A, if you have any questions about that, I'd be curious, or I'd enjoy going into a bit more depth on that. But we're mainly here today to talk about, as the title says, the ever-changing opportunities and risks for European investment in China. Of course, China is not, a black and white kind of market. There's a lot of gray, and being able to parse where real opportunities are available as compared to things that are just on paper is important. But it's also important to be able to recognize where are the sort of long-standing and the new risks emerging in this important market. So I'm going to start with this lovely slide that is found in our position paper. We actually had the help of the World Bank in putting this together. So what you can see on this chart is essentially the growth potential that China has along three different projections. So you can see on the x-axis is essentially the start and number of years after the beginning of market reforms in these different markets. So we have Japan, Korea, and Taiwan, and you can see the GDP per capita in PPP terms going up from there. And you can see sort of in the center here, you have China about 35, 40 years into its market reform story. And in many ways, it's kind of kept pace or maybe even underplayed compared to these other East Asian markets. And from there, we have these projections that the World Bank put together for us of what happens if China really comprehensively introduces and completes its market reform process, if it kind of stays at the same pace as going now, or if the pace starts to slow down. And what we really see there is the main reason why companies are here. They're here for that growth potential. I mean, the growth story in China has already been, as demonstrated over the last 4 decades, extraordinary, and it will continue to be so, even in a situation where reforms don't progress at the speed that we quite hope for them to. So this is what really draws European companies here, and this is what keeps them here. And importantly, a lot of the European companies that are here to service the local market. I think a lot of people have this assumption that foreign companies in China are producing for export. That may have been the case 2, 3, 4 decades ago. That's no longer the case. Most of our member companies are, as we say, in China for China. They produce in China and they sell to Chinese customers. However, not everyone's able to come into China to provide their goods and services to Chinese consumers. A lot of different barriers to foreign investment continue to exist. And we generally break this down into the direct barriers and the indirect ones. Now, the direct barriers are what are called the negative lists, which is essentially a series of different lists that say these are the areas where investment is prohibited or restricted or conditional. So there's the notorious negative list for foreign investment that only applies to foreign companies. The list is actually, in absolute terms, quite short. There are only 37 items on this list, and some of those items are really insignificant or not really of interest to foreign companies. One of these items is a traditional Chinese calligraphy paper, which I can't see very many European companies too worried about those sorts of barriers. However, there are also things like telecom services and what China calls value-added telecom services. And that's stuff like data storage and management, cloud systems, VPN. And these are not only important for companies right now, but they're of growing importance across all industries, as even traditional sectors like chemicals or machinery are starting to incorporate a lot of digital solutions into their offerings. to help automate their plants to take full advantage of the Internet of Things, and without the ability to bring in their preferred digital solutions, because of market access barriers like this, puts them at quite the disadvantage. You also have what's called the market access negative list, which applies to Chinese companies as well. And this list is hundreds of items long. And it's really the bigger source of issues for a lot of companies. So for any investors that are out there potentially looking into China, make sure you're not just looking at the foreign investment negative list. There are others as well. The indirect barriers are where, frankly, more of our member companies run into issues. For every three barriers that are encountered, our members report that 2 of them are indirect and 1 of them is direct. So you're twice as likely to run into them. And these are things like licensing requirements, which in the case of something like financial services, where the negative list has been, the items on the negative list have been removed, you can now invest as a fully foreign-owned bank, but you need licenses to provide certain services. And if you're not able to get those, then what good is the investment? You also have a lot of administrative approvals. And then on top of that, you have a lot of public procurement system issues. Things like, a lot of our member companies report that tenders are often released with very short bidding windows. And it's an open secret that that sort of favored local companies, especially state-owned ones, are the beneficiaries of this, as they'll often, have a connection in government where they get to see that tender ahead of time, so they can prepare a competitive bid. So these are some of the risks that European companies deal with on a day-to-day basis. But there are a lot of uncertainties moving forward. We have an issue that we call the one economy, 2 systems model, in which essentially one half of the economy, things are getting a lot better for foreign companies. The market is opening. The playing field is increasingly fair and level. And also regulation is coming through that looks a lot more like what they're accustomed to in Europe, in North America, in Japan, and Korea. The other half, though, is increasingly dominated by state-owned enterprises and by national champions. And these are in a lot of kind of upstream areas, things like steel and oil and chemicals. But it's also increasingly in some of the more important and sort of cutting-edge industries. So, China has national industrial policies where it identifies certain industries where it wants to advance and become competitive in. And what this often means is that either state-owned or increasingly private companies are sort of handpicked to be the Chinese company that's going to succeed, whether it's because of state support or market access barriers that prevent competition, so that they're able to get exclusive market share. And so that half of the economy, the risks are really growing. We also have this thing called dual circulation, which is sort of the new buzzword that's been popping around Beijing the last couple of months. And the idea at its core is that there's an internal circulation, sort of a domestic market, and there's an external one, which is more engaging through trade, so importing things and exporting things. And frankly, no one really knows exactly what the system is yet. It's being used as part of a debate within the policymaking circles here in Beijing. But a lot of the companies that I speak to view it as either a really good opportunity or as a really big risk. The ones who are viewing it as an opportunity tend to be the further upstream ones. Or the ones that are selling directly to Chinese consumers. So if you're in consumer goods or automotives and luxury cars, things like that, it's a huge opportunity, because the goal of this, one of the explicit goals of dual circulation, is to build a stronger domestic market and to increase domestic demand. So that's great news for anyone selling directly to consumers. However, it's viewed as a risk by others in that there's a huge self-reliance component. So again, a lot of those same industries that are part of China's industrial policy that I mentioned earlier, also the foreign companies in those sectors view this as a risk, because they worry that they're going to be essentially pushed out so that China can develop self-reliance in those areas. As far as outlooks go, our member companies are pretty divided. You can see here on the left is when it's from our business confidence survey. It's when companies expect to see meaningful opening in their industry, and on the right is when they expect to see a level playing field, like true national treatment. And then we ask them essentially when they expect these things to happen. And as you can see, there's a small chunk that's very optimistic, a pretty sizable chunk that is kind of moderate in their opinions. But we have 21 and 29% respectively saying that they don't expect to see meaningful opening ever, or significant improvement on the level playing field. So again, this really speaks to this sort of polling forces in China these days, where things are, again, getting better in one half and getting worse in the other half. Nonetheless, our companies remain very confident in China, the ones that are already here, with those few exceptions that I mentioned. Again, they look at that growth potential from that World Bank chart I showed you. They look at the potential of Chinese, consumer growth and the amount of industrialization that still has yet to really occur in certain places. And so European companies continue to look at this place mainly as a land of opportunities. Also importantly, is what you see in this chart right here. So every year in our business confidence survey, we ask our member companies how innovative they think Chinese companies are compared to European ones within their industry. And as you can see here in 2018 was the first time that a majority of our member companies said that they view Chinese companies as either more or equally innovative to European ones. And as you can see over the last couple of years, that's grown to the point where 70% of companies say this. And this is another really essential component of a lot of companies' investment strategies. Is China is not just a growth market, it's increasingly an innovation market. And companies want to come in here and be exposed to competition with innovative Chinese companies. In a lot of areas, Chinese firms are on the cutting edge. They're global market leaders. Any and all things digital being, such an obvious example. So European companies are eager to be part of that, the same way that they're eager to compete in North America or in Japan or in a lot of these other markets, because that competition to other innovative ideas helps them innovate. And that's one of the increasingly important lures that brings companies into China. So I'll leave it there. We could talk about a lot of these things indefinitely, but I want to be conscious of time. So I'll leave it over to the rest of the panel to continue the conversation, and then we'll go from there.
Thank you very much, Jacob, and I think that's a really good insight, which we'll come back to in some of the questions as we go on from here. I think there were 2 points that you highlighted that I'd comment on immediately. One is that organizations going into China are doing it because of the value inherent in the domestic market today, and I think that's something that we truly see on that front. It's particularly the case, and I link that to the observation you made about restricted industries and value-added telecommunication services licenses. One of the reasons that Chayora and Telstra are collaborating in the way that they are is that we are two of a very, very small number of international businesses that hold a number of such licenses. Matt will say, and CT will say a little bit more about the Telstra coverage, but between us, we've managed to find a route in that enables us to offer the confidence perhaps of dealing with an international business that understands this restricted industry, whilst at the same time operating very fully in compliance with all Chinese regulations. And as you rightly pointed out, the regulations are deep, extensive, and incredibly complex. It's been a learning experience for us all, I think, on that journey. So let me transition and let me bring in my other two guests on this session today. I'd like to go first to Matt Williams. I mentioned earlier that Matt is the head of Europe, Middle East, Africa for Telstra. And Matt, I think in the light of Jacob's observations there, it would be very interesting for you to perhaps share a little bit in terms of a little bit about Telstra perhaps, but also what you see as being the biggest challenges that foreign companies face today when they're trying to connect into China. So Matt, can I perhaps bring you in and give us a little perspective from your side in terms of what you've been seeing?
Thank you, Oliver, and thank you to everyone for the opportunity to share a few of our views. So I'm Matt Williams, and I work for Telstra you might know Telstra as the incumbent telecommunications company of Australia. Naturally, because of our geographic location, as we have grown beyond our domestic borders, we've done so through the Asia Pacific region. And we're very proud of our heritage there and the fact that we are probably the best or the most embedded. We have the broadest network infrastructure and cable systems in the region, but also, as Oliver mentioned, quite a unique position in the Chinese marketplace. But I work here in the UK. My job is to run the European business. And so we serve Western European, Middle Eastern, and African organizations, predominantly in terms of how we fulfill their communications needs into the Asia Pacific market. And I'll let my colleague CT describe a little bit more about our capabilities, specifically in China, when we get to CT. But what do we see in terms of those challenges facing European companies today when connecting into China? Well, obviously, we've covered a little bit around the geopolitical challenges, trade disputes, currency issues, market restrictions has been covered. And so we appreciate that is challenging. But we see that investment in China is absolutely long-term, and I think it's very interesting from Jacob's research of the perceptions really as to whether the market is open and how easy it is to do business there. And I think it's very encouraging that year on year there's a perception that the market is becoming more open, and actually it will take a shorter period of time for it to improve. I think the second issue we see is around compliance, and so we've touched upon the difficulties in delivering communications infrastructure, and we know that all too well and are embedded in the market there. We've been there for around 30 years and have managed to navigate some of those complexities. But we see that there are significant considerations required for business operations, particularly around communications, but other things, licensing, for example, and management and compliance with this regulation is very, very important, especially stakeholder management. Then other things, particularly in our business, to give you a perspective. So geologically, China, in fact, that part of Asia is prone to national disaster, maritime disputes, and the shipping industry in China is huge. And so we do see significant difficulties in running cable infrastructure into China and running infrastructure generally. And so it's crucial that European companies work with a trusted partner who's invested in this area and has those long-standing processes, relationships to essentially overcome all of that.
Okay, Matt, look, thanks very much for that. I think a great introduction on that front. And let me now just introduce CT Yan. I've known CT for a good long time now. Between Chayora and PBS, that CT is the chief executive of, we're working very, very closely in terms of the delivery of services and bringing in solutions to international customers and domestic customers who are looking for data center solutions. So CT, a warm welcome to you. Great to have you with us. Perhaps you can build a little bit from the Chinese end perspective. You're based in China, you've been running this business for a number of years. And what's perhaps some of the issues that you feel should be considered most closely from international companies coming into China that perhaps haven't been covered by Jacob's comments so far in terms of the issues that are of concern? CT, welcome.
Hi, Oliver. Thank you. Okay, I think there should be quite a lot of the issues that as an MNC, when we go into China, I still remember more than 10 to 20 years ago, when we go into China, we find a lot of the issues. And here are some of them that I want to, maybe I can share. The first thing that I can share, especially in the recent year, is that about the as an MNC, I think we have to be well prepared to innovate fast in China, because there are a lot of the local competitors that they can adapt to the new technologies very quickly. But I can see a lot of the MNCs, they are still burdened by the experience over the past 20 or 30 years in those developed countries. And due to the huge local demands in general, in fact, in China, and the government also, as what Jacob also mentioned, the government may also support a lot of those domestic enterprise, including the state-owned enterprise, to compete in almost all the major industry in China. So I think those low domestic companies, that they always compete, with price, and also they move very fast, and they can develop in a very massive way in terms of both the technology and also in the location coverage. So I think this is one thing in China I can say should be fast, even faster than overseas. And the second challenge that I think from our experience is that in the past, we always, we always always say that, the staff members are the asset of a company. So I think this is very more important in China, because especially when we are talking about 1C, that means the relationship. 1C is a Chinese terms relationship that built among the companies and people. However, what we find in the past is that to hire the experienced people in China is very important, as what I said, but difficult. In China, most of the companies, okay, even though they are very big company, but they are still very young. This is what I can say in terms of the years of operations. So they are either very young, or they are very traditional, that they, this is very, so there is still a big gap between the international standards and the Chinese standards. So search for people with the experience, and they own both the local knowledge and also the global mindset. Sometimes it is really very difficult and a challenge. And also, since the development is so fast here in China, and a lot of MNC, I can say a lot of the MNC, including a lot of the Fortune 500 companies, they have been moving into China in the past 5, 10, or even 20 years. So there are a lot of the job opportunities in the market. So I can say the demand of people is much larger than the supply. So what I can say is that not only to hire people, but also we have to pay high attention to retain the talent in the companies in China. Yeah, so yeah, it's still a lot. For example, I can also think of there should be a lot of the market. In China, there are a lot of the cities in the market. So not only Shanghai and Beijing. So I think when we go into China, so I think one of the things is that we have to do some proper due diligence and also research about some particular cities or particular markets, and before we go into China. So always remember, we always say that China, we have altogether 31 provinces plus 31 provinces plus municipal cities. So I think many of the MNC, when they go into China, they will just think Beijing or Shanghai or Guangzhou, etc. So I think there are a lot of the provinces and a lot of the cities in China. So I think these are all the things that we have to look into and to be very careful.
CT, I think those terrific points on that. There's numbers that I'm going to pick up on when we get into the wider discussion in a few moments' time. But I will segue with one of the points that you've made there that I often find. I first went into China a little over 30 years ago in the late 1980s, and it was a very different world from where it is today. And my visits to China have been very frequent and many. And 2019, I went into China. I was going through my passport the other day 40 different times in 1 year. Unfortunately, due to COVID, I've only been to China once this year, which was last January. And I've got no idea, Jacob, when I'll be coming up to meet you up there. But I want to make one point, and then I'd like to show the video in terms of the facility that we're currently jointly operating and we've developed as Chayora. But it is that key point about the market in China. China has 1.4 billion people, just under 20% of the world's population. And that number fails to resonate with many people until you explain it in another way, which is 1.4 billion people is the same as all of the countries of North America, so Mexico up through Canada, including the US, plus the 28 countries of the European Union, which for the moment, Jacob, I'll include the UK in that one because we've got a couple of weeks more, I think, before the final barrier comes down, plus all of the countries of the former USSR, plus 10%. Now, you can't address that as a single market. You've got to think, as you said, about the 31 provinces and the special administrative regions and the like. And indeed, when we're seeking to compete in that market, and the opportunity for international companies means it's a very, very big market. And it takes years and years to even get a sense of perspective, let alone any sense of deep understanding, which I can say from personal experience. But look, let's just transition. One of the things that's critical, as I said right at the outset, is having an environment where people can be based. And we'd like to show you, part of the reason for hosting this webinar is that we've recently launched the first facility on the Chayora data center campus, which is just outside Beijing, about 100 kilometers outside. And in latency terms, that's very close. So less than 2 milliseconds for a round trip for a packet of data to go from our facility back to the CBD in Beijing and back to our site. This is a facility that's been designed to accommodate the highest demands of the world's leading cloud players, around half of which are Chinese and half of which are not Chinese, as well as the many enterprise providers and the smaller occupiers. And with Telstra and PBS, CT's business in China, we're targeting very specifically world-class co-location services. So anything from a rack up to, we'd say, 25,000 racks. So let's, rather than carry on talking about that, let me just give you a 2 or 3 minute video that gives you a fly through of the facility. So let's run that video now, and I'll make a couple of comments as we go through. This is a live and complete facility, of course, now. Thanks very much for that. So that's a very brief snippet on that, but what we will do is we'll provide to everybody who's joined us for this webinar, we'll provide a copy of Jacob's slides and also a longer version of the fly-through video of our facility. Data centers are, of course, where the cloud lives, is some people describe it, and where all your texts and all your emails are channeled in terms of communication, and are critically important in that regard. And what we know is that very often international companies coming into China fail to understand many of the points that Jacob was highlighting. But I think it would be interesting to perhaps explore a route which enables us to perhaps start with a point, Jacob, that you raised, and I'll perhaps come to you, CT, first on this one, because the innovation that we see with Chinese firms and the creativity is dramatically different today from where we were a number of years ago. The perception historically was that China would copy what international companies were doing and then improve on it. I think these days you've only to go to Shenzhen in the south of China, and the areas of the free trade zones around Shanghai, the Tianjin-Beijing corridors, to see extraordinary investment, research and development into things like autonomous vehicles and smart cities and the Internet of Things. CT, inbound companies, what do you think from they can learn from the innovation and the new ideas that are taking place on the ground in China? How can they benefit from that?
Okay, maybe I can share one thing. The digitization or the digital transformation has been moving very fast in China. Just take an example. Nowadays, I won't bring any money notes when I go out to shop or do whatever within the mainland China. Okay, as we we can pay using my mobile apps, such as with the Alipay or the WeChat Pay, for example. And also, even the government, okay, they has been digitally transforming. For example, you can go to the restaurant after your dinner or your lunch, you get the receipt. That through the electronic receipt, and those electronic system has already linked back to the country tax system already. So even the government, enterprise, and also the daily many things, they are already digitized in China. Okay, so last year, in fact, Telstra has launched a research white paper that called the disruptive decision making, which we look at how well an organization across the world that make digital transformation decisions. And in the survey, we have interviewed more than 3,000 persons from various enterprises across 14 countries. In one of the questions, we asked the companies to consider their digital transformation in light of 4 factors. Okay, the 4 factors are people, process, technology understanding, and partnership. Okay, people, process, technology understanding, and partnership. Okay, and very interesting finding is that we found those organizations in China, they feel that their focus on people is the strongest factor in the digital transformation decision making. And this is followed by process, and then by partnership, and then the last one is technology understanding. That means people, process, partnership, the 3 Ps, and then the technology understanding. However, the interesting thing is that this result shows a significant difference with the global results, where in the global result, the technology understanding is the strongest element of the decision making by some distance. And then offering almost a mirror image of the Chinese results. So and then we try to understand how about those digitally mature organizations, and we find that those organizations, according to the survey, they said that processes and people were the strongest factor contributing to the digital decisions. That's supporting the Chinese approach. And this is what we can learn, is that we should focus on people, focus more on people and process. And this is the key key success factor why those Chinese organizations can do the digital transformation in that success way. Okay, so I think this is one of the things that we can learn.
it'd be great for anybody who's online if we can provide a copy of that white paper, because I think that's quite interesting on that front. Jacob, let me come to you just to pick up on a point that CT makes an interesting point in terms of the things that people focus on, which might not be what one would expect. What about the broader issue of terms, the concerns that European companies have got, particularly about, there's a fear factor when you're working in a complex market like China, but that it's often quoted things like IP are major concerns. What's the position of the European Chamber in that regard at the moment?
Yeah. So, I mean, tech leakage is of course a long-standing and major concern. Generally speaking, I like to divide it into two separate issues. So there's first, the traditional ways that IP is infringed upon. So that's things, like someone setting up a factory down the street from you and they start producing the same product under the same brand name, standard counterfeiting and such. And in that regard, things in China have actually gotten a lot better over the years. And it certainly hasn't happened, out of the goodwill of trying to, answer the needs of foreign companies. It's because Chinese IP needs to be protected. And as China continues to build on its innovation, and there were more and more, legal cases and conflicts and cases of counterfeiting between Chinese companies, the government responded. And foreign companies just happen to be a beneficiary of that. You also see a lot of really positive progress in these IP specialist courts that have been created in Beijing, Shanghai, and forget if it's Guangzhou or Shenzhen, but one of the two. And then they're actually replicating that system into several other cities. So I think Chengdu, Chongqing, Wuhan, and Nanjing are all set to get theirs as well. So in that sense, when you look at our business confidence survey, the number of companies that have said that they're actually satisfied with the enforcement of IPR provisions has been steadily climbing for, I'd say, the last decade or so. A separate but related issue is forced or compelled technology transfer. And that is less of an IPR issue, and it's more of a market access issue. It's that you're not allowed to come into the market unless you, transfer technology. Historically, that happened in ways that were very blatant. It was that, it was written into laws, or it was somebody walked up to you and told you, okay, if you want to get your approvals, you need to transfer some technology to somebody. Nowadays, it happens mainly through the maintenance of joint venture requirements. So if you want to bring you want to invest in, a new auto plant here in China, up until recently, and still to this day in passenger vehicles, you have to have a joint venture partner. And so if you want to bring the best technology to China, then, which foreign companies tend to want to do, especially now that Chinese consumers demand the cutting edge technology, then you essentially have to share that technology with your joint venture partner. So yeah, I think that's a good way to divide it. And I think on our last business confidence survey, 19% of companies said they had issues with compelled technology transfer. And about a third of those happened within that year. So that's still very much an issue. And it's even a growing issue, again, because Chinese consumers demand the best products. In the past, a German or a French or a Swedish automaker might bring in technology that was 5 years old in their home market, but they can't sell that in China now because Chinese consumers want something better.
I think that's a really, really good set of points that you've made there. Thank you for those, because I do think that the perception and reality, there is a gap and a time lag between international, particularly people who've not spent much time in China, and we would echo those views in terms of the robustness of commercial contracts that you can enter into. It's complex anyway. You never want to go to the courts, but actually there is a good process and a clear route. Anywhere in the world you go to the courts, you lose, I think, in financial terms, but regardless of the merits of the case. But let me segue, Matt, let's come back to you on this. One of the other points that CT mentioned was about people and processes, and One of the areas I always think that's quite interesting is that you very often start, as Jacob was just saying, working in relationships with local firms, whether it's relationships with government, and we know that the public and private sectors are very closely intertwined, and that mindset is important because it's all about progressing the economy. But maybe I ask you, Matt, on that front, from Telstra's experience, how do you know when you're in a good place in your relationships with your local partners in China? How does that factor come into play? Matt?
Yeah, great question, Oliver. So I think, well, firstly, in terms of operating in China, Telstra has 6 licenses which needs to be renewed every year. And so you have to be aware of changes in the local environment, changes in people, and to stay on top of those relationships. So you need to be on the ground. And you need to, as CT mentioned, have people who are experienced in managing those processes in those organizations. In terms of partnerships, I mean, that's, again, we've mentioned that. And if you're new to the marketplace, absolutely essential to find a good partner who can help you to navigate the complex regulatory landscape and marketplace. And so we work with a huge number of foreign multinationals. And so I think that's a good measure for us in terms of our status and presence there. I think in terms of flexibility and the ability to move quickly, that's something too which we've spoken about, particularly where innovation is critical and it forms it's essential for your competitive advantage. And so being adaptable to new practices and being able to move with the times essentially very quickly is also essential. I think in terms of people, so we've mentioned people already, and CT mentioned retention is key. And if you're able to attract really good talent with local relationships, that's critical. But balance that with the presence of maybe people from within your organization as well, and to embed them so that you can also bring best practice and that company culture into the organization. If you manage to do that, that's also fantastic.
Great.
Then I think.
Yeah.
There's one other point is around the due diligence around provincial investments, and it is an absolutely huge market, and there are so many stats which are mind-boggling. But I would say that if you're present across the country, then you need to be aware of the provincial differences and to manage that. And so again, a good measure of how embedded you are is how distributed you are, I guess.
Good. Yeah, I think that's fascinating on that one, and I think those are all, again, good points on that front. As we come to the back end of this seminar, I think some of the questions that might be interesting to explore, and I'll go around to each person on this, is how best to bridge the gap between having the mix of locally hired staff, having regionally hired staff and international staff, and how do we address the challenge of the cultural bridge? One of the big challenges, and I speak as a European educated individual, was that when I was at school, I learned about 3 things about China, and that was that at the time it was run by Chairman Mao. I knew where it was on the map. And I had some perception about, that it was an agricultural economy that grew rice, and that's a desperately poor educational outcome. Many of my peers of the same era have obviously learned a great deal more about China, but many have not been to China, and therefore there is this the challenging cultural terms of bridging it. And Jacob, maybe if I come to you, because we have a very wonderful and diverse range of cultures across Europe. All of whom have their own proclivities and styles and ways of doing business. How does the European Chamber, help those organisations to enter China in the right way and get successful as a consequence? And I'll come to the CT and Matt's comments on the same question afterwards. Jacob, to you.
Yeah. So it's an interesting question. Finding that right balance of foreign staff and local staff, and making sure that you develop a corporate culture in which they can all actually not just get along and have basic common understandings on things, but also bring out sort of the synergies that you get it can be very challenging. And frankly, a lot of our member companies are very, very, very extensively localized. There are quite a few of our members where there aren't any foreigners working there. If it wasn't for the fact that the name is of a European brand, or it's clearly a Dutch name or a Polish name or something, you wouldn't really know that it was a foreign company. In general, though, the companies that I speak to that do the best are ones who build kind of a rotation system. So they want to make sure that the Chinese talent that they bring into their operations are not just in China forever. Anyone that's identified as someone who will play an important role in the future of the company, they will rotate them back to headquarters, or they'll rotate them out to the North American operations, or the Australian ones, or the South African ones, to get that more global perspective. And then at the same time, one of the most common complaints that I hear from the HR managers of our member companies is that they want to be able to bring more, especially young foreign talent into their China operations to kind of catch what they call the China spirit, of sort of in many ways just saying no to a lot of traditional assumptions, to being willing to say it doesn't need to be 100% perfect. If we get it 90% of the way there, we put it on the market and we figure out the other 10% later. And Chinese consumers are quite willing to accept that in many ways. And yeah, there is this need for that kind of rotation. And again, a lot of our members say that they want to bring younger foreign talent in to catch that spirit and then take it back to headquarters, or take it into their South African operations or their Brazilian operations.
I like that. No, I think that's a really that covers quite a lot of that. And yeah, thanks Jacob for those comments. And perhaps, well, let me change the emphasis slightly on the basis you covered a lot of the bases there for coming back to CT first on this one. A good question we've had from one of our sort of participants here is, what do we feel is the single most important aspect for international customers to be successful in the China market? And given we've got 3 or 4 minutes just to wrap up, maybe I could ask for a minute's kind of response on the thought from each of you on that. I'll come to CT, then Matt, then Jacob, and then I'll wrap up with that. So CT, what's the single most important aspect for international customers to be successful in China?
Look for a partner. Okay, just like Telstra, when we moved into China, we also look for a lot of partners, including Telstra PBS. So I think that a very short answer is to look for a reliable partner that can help you to navigate through the complex environment in China. So I think partnership is the most important one, including the partnership, your business partner, the government as a partner, and also even sometimes your customer also as a partner. So look for one partner or even a few partners to help you. This is the most important, I think.
I think that's key, and we're delighted as Chayora to be in partnership with Telstra in the market today. So a really good important point on that one. CT, Matt, what about you? Perhaps another angle. What do you think the most important aspect is?
I think the most important angle for me is to build on CT's point, is to take a long-term view, and to really work with those partners to embed yourselves, to work through the different complexities. And then I think, as we've experienced, you can really see the fruits of your labor and the fast growth that you'd expect in that market.
Yeah, okay.
But it takes time.
That's a good one. Yeah, excellent. And Jacob, what about you? What's the single most important aspect out of all of the important things that you've talked about? What are we going to pick?
I would actually say having really good government affairs and government relations. So not a surprise answer coming from someone working for a chamber of commerce, but the simple reality is that government is getting more involved in business in a lot of ways. Things are becoming a bit more political, but also regulatory change in this country happens so quickly and often without warning. And building up a relationship with your interlocutors and the government is really critical. To stay ahead of compliance risks, but also to be able to identify good opportunities.
Again, I couldn't disagree with that one at all. And to my part, what do I think the most important aspect is? Well, perhaps to complement the points that each of you have made, one of the things I've learned in going into China is that you need to go in and you've got to suspend judgment on scale. I always used to think when I grew up that big things came from Texas. I now know that the really big stuff in the world at the moment is coming out of China. And the term China scale is something which exceeds hyperscale. I never cease to be amazed at quite how big the cities are, the markets are, the developments are, the vision of government is in urban development and the like, and that presents immense opportunities for international businesses to to engage in an exciting, prosperous, and I hope global economy that China has become increasingly over recent years. So I think there's lots of things that we've got to think about there. One of the other things that we've got to think about, of course, is time. And now exceedingly fast, and we said we'd come in at the 5 to the hour. So I'm going to draw it to a close there. I'd like to thank firstly Jacob Gunter. Jacob, thank you very much for your contribution. I think it's a terrific treat. I'm looking forward to us meeting next time I can get back up to Beijing, and thank you for all your contributions there. I'd like also to thank Matt Williams and CT Yan from Telstra and Telstra PBS respectively, our partners in China. And lastly, I'd like to thank all of you who've taken the time to attend. And I hope there's been one or two points that has come out of this that will make you think a little bit differently. And I'd encourage you, please, as appropriate, to be in touch with Telstra, with PBS, with the European Chamber, and indeed with us at Chayora. So thank you all very, very much. Thank you for the participants. And with that, I'll draw this webinar to a close. Have a very good day in Europe and a very good evening over in China. Thank you. End of the session. Bye-bye.
Bye now.